Oh yeah. Okay. In this one, we're going to talk about the bump and run, and it's an actual reversal pattern. Okay. So I'm just going to get my screen draw pen out and show you basically what it would look like. You'll see the market as the market starts to make its incline. It will then push away from it. Okay. Now this formation was apparently devised back in 1997 or something or another, and the way it works is like this angle here is, I don't even know how they're managing to work out these angles, but this angle here is supposed to be 31%, and you take this trend line to the new trend line up here, and this one is supposed to be 47%. Okay, but in any case, I don't think that you would really need to worry about working out what the percentage of the angle will be. Okay, because for the most part you just need to understand what the formation looks like, and when you've got your trend lines already drawn in and you start to see it peel away, this will be the actual bump and run formation being developed. Then what you want to look out for is this first break. It needs to break out there first, and then as the market starts to drop and it breaks right there, that's that particular point that you want to sell. Alright, so let's go ahead and show you basically what that would look like on a chart. Alright, okay, so there we go. So we've had quite a few breakaways here. Alright, so we've got our normal trend line. Okay, we've got a normal trend line. We've just drawn it from this point to this point, and you can see that how it's come all the way down, and eventually it started to break away. Alright, then you want to wait for the market to break that line, which it had done right there, and then you need it to break this particular line, which it didn't. Alright, it started to resume its downtrend and it formed another breakaway. Alright, and then it tried to break up the top here again, and eventually it broke down the bottom. Now again, I don't really like this strategy. I don't even know why the guy introduced it, because it doesn't seem to be very reliable. The only good thing that I can take from this is that it does give you an indication that there is a possible chance of a reversal. Just a possible chance of a reversal. Alright, nothing like a guaranteed chance. Well, there is really no guarantee things in in the forex. It really depends on how you do your analysis, but you can see that it doesn't really look like a very comfortable way to actually act off it. Alright, and nothing else. So we would probably have to use like candle patterns and stuff like that, and maybe incorporate the Andrews pitchfork or something that we will be talking about a little bit later on. Okay. Okay, here is probably another example that we could use. Alright, and as the market was coming down, it broke away. Alright, at the particular point where you drew these on your charts, this could have been the day that you had actually turned your PC on to do some trading, and you've drawn this line down and you've started to see that it's broke away. You wait for the break of that line, then you wait for the break of this line, and there it goes, it breaks. Alright, so there you have it. There is the break and run, or the bump and run, as they call it. Okay, so I will leave you with that little video, and I will see you very soon in the next one. Bye for now.